This is Pre-Market Prep. I'm Brianna Valesky here with my co-host Joel Elconin. We're joined by Randy Frederick. He's the Managing Director of Trading and Derivatives for Charles Schwab Center for Fiscal Research, as well as Kelli Keough. She's the Senior Vice President for Schwab Trading Services. Kelli and Randy, thank you so much for joining us. How are you both doing this morning?
Great. It's great to be with you.
All right, Randy.
Yeah, it's great to be with you. Thank you for having us.
Absolutely. Randy, let's start with you. What does your role as the Managing Director of Trading and Derivatives entail?
Well, my role really has three main components. I do research, education, and PR. The research focuses on economic and geopolitical events. My expertise is in the area of listed options and equities markets, and to a lesser extent, the futures markets. The education part of it is in a number of different ways: client events that are live, webinars, written content on Schwab's website and in the newsletters. And the PR that I do is in pretty much all media formats: television, radio, podcasts like this one, print, and social.
We're in the heart of earnings season right now. Randy, what has been your impression of the reports we're seeing from these public companies?
Well, about 40% of the companies in the S&P 500 so far have reported, and the earnings per share results have been pretty good if you compare them to the expectations, which were pretty low. At this point in the game, about 73%, I think, have exceeded the earnings per share targets. But I think it's important to realize that those the earnings expectations bar was lowered quite a bit, and we've seen that for the past several quarters. We're already seeing that for the quarter that we're in right now. Revenue results have been pretty disappointing overall. About half, only just a little bit over half of the companies have exceeded the revenue targets. That sounds pretty good, but when you look at it compared to previous quarters, it's not so great. When you look at it on a year-over-year basis, it's also not so great. Earnings targets have largely been exceeded by cost-cutting and lots of corporate share buybacks, which we hear about continually. And the revenues have increased only about 1% if you compare it on a comparable quarter from the prior year. So I think that's why we have seen this sort of really tepid response in the markets, with the exception of just a few really high-profile names. Much of the blame, of course, can be placed on two things that have been a big impact on the markets overall, and that is falling oil prices, which are still down about 50%, and the dollar, which continues to gain strength. It's up about 15% since last year. Those two issues are likely going to continue to be a problem as we proceed through Q3.
Hey guys, make sure to make a point. Randy is pointing out that we need to keep a realistic view of earnings season. Watch oil prices, watch the U.S. dollar. But Randy, are there any specific trading strategies you like to use during earnings season or other times of volatile trading activity?
That's a great question. I've actually written a lot of articles on both of those things. Some of them are on our website at the moment. During earnings season, I think it's important you have to decide on what it is that you are trying to take advantage of. So typically you have two issues in earnings. Or during earnings season, you have big swings in volatility. Volatility tends to pick up before an announcement and then drop sharply after. And you also have big price moves that come out if the companies either meet or exceed their targets. So some strategies are designed to neutralize that volatility and focus on price changes, and some are designed to do exactly the opposite, to take advantage of the changes in the volatility that come before and after. If you're an options trader, which are some of the people I speak to, you can use strategies like any kind of strategy that involves long options, like long calls, long puts, straddles, and strangles. Those are strategies that if you take them on before the volatility increases, they will gain value. If you're trying to take advantage of the big drop in volatility that happens after an earnings report, then do the exact opposite. Do short calls, short puts, short straddles, and strangles. And if you're trying to neutralize the volatility because you'd like to take advantage of the price move that you think a stock might incur when it announces, then you want to put on a strategy that can remove the volatility component. And typically a vertical spread that's pretty close to the money will be one of the best ways to do that, because it has a long option and a short option, and then the volatility swings tend to cancel each other out mostly.
Some great trading strategies there. Kelli, you are the Senior Vice President of Trading Services for Charles Schwab, but you also have a PhD in psychology. Before we dive in, can you talk a little bit more about your role at Schwab and how your background in psychology comes into play?
Sure. So my team and I are responsible for the active traders at Charles Schwab, as well as those traders at optionsXpress, which is part of the Schwab fold. And we focus on those our active traders and understanding what their needs are and then providing them in their platform. So we focus a lot on how do we help create a trading platform that works really well for traders, this kind of strategies, for example, that Randy mentioned. Education, we work closely with Randy and his team to help make sure that our traders have, I'd say, learn new techniques and are able to change with the markets. We also provide great research as well as the service that we provide. So we focus on those key areas which are most important to traders. You asked about psychology. It's, all the way through, if you think about trading, it's really an emotional game. It's about trying to master your emotions and channel them appropriately, and oftentimes setting them aside so that you can make good trading decisions. And one of the benefits of having a psychology background is it helps us hone in on some of those challenges that our clients face. We help educate around it, and we even build our platform around it. So, for example, we try to help our clients, as soon as they're placing an order, right away build in risk management techniques so it's easier for them to follow a trading plan with an exit strategy, either on the upside or the downside, right when they're getting into a trade. So that helps them so that the emotions don't get the best of them if the market takes a turn that they don't expect. So we really try to weave it into the entire experience for our active traders, as helping them along the way be better traders.
I'm glad you specifically mentioned risk management. That's something we focus on a lot in our show. Tell us, who are the Schwab Trading Service clients?
So our Schwab Trading Services clients, at the heart of it, they're traders. They are retail investors who are interested and usually very passionate about the market, very engaged. They love to follow the markets, study the markets, read about the markets, and they know trading. And they want a partner or a firm that knows trading as they do and can be that partner for them along the way. I think it's important to note that many folks, when you say an active trader, they think of maybe the early 1990s day trader who's in their early 20s and trading on a small account. But actually at Charles Schwab, our clients really couldn't be further from that. They're established traders who really only trade a portion of their portfolio. On average, they trade about a third of their portfolio, and the rest of it is actually invested in longer-term holdings. So they're able to allocate money toward those kind of higher risk strategies or strategies that allow them to stay engaged with the market, while at the same time being they're really sophisticated, well-educated investors on the other side of their portfolio.
I know you recently conducted a survey, a Schwab Trading Services sentiment survey at the end of June. Can you take us into the current mindset of the trader? What's their outlook right now?
Yes, our traders, I would summarize it as this, that they're overall bullish for the kind of medium term, but currently cautious. And so let's dig into what that means. So in the survey, when we conducted it toward the end of June, we saw that we actually had a significant uptick in the percentage of traders who were bullish over the next 3 to 6 months. They thought that the market would be trending up. In fact, 46% of our traders said that their outlook was over that period was bullish, and that was a significant increase from the 32% just in March. So we had seen an increase in the medium-term bullishness, and we actually saw quite a decrease on the bearish side as well, with the neutral group staying about the same. We also, when we asked them how long they think that the current bull market's going to last, over about a third believe it's going to last at least 6 months to a year. And another third, about 36%, actually think it's going to last a year or more, actually into multiple years. So as I started out by saying, I think in that medium term, our clients are bullish. But then if we look at where are they today, we tend to see a bit more caution. And we hear in our community, and I know Randy hears this in his talks with clients, there is that concern about a correction, and we'll talk maybe a little bit more about some of those concerns that clients have. And that concern is, I think, driven by the fact that 80% of them thought that the market was currently overvalued. So there's a bit of a tension between where are they today and where do they think that the market's going to go in this midterm, kind of the midterm.
How is that outlook kind of translated into the trading activity? What do you see clients doing right now?
I think so. Let's go to that cautious versus bullish, and I think we see actually evidence of both of those in the trading behaviors that we've seen. So if we look back at June, our most recently publicly reported month, in the industry there was actually it was a slower month in June in terms of trading activity. But even in that month, Schwab clients were net buyers of securities, so still in that bullish side, as well as continued to bring us assets, and they've been keeping their assets here. So we know that even if they're not trading as much, we know that they're engaged and they're here and they're waiting. I'd say July is a little bit of a different story with the geopolitical changes that have been going on, as well as the earnings season. We've actually seen our clients become more engaged in July, and as we see the Fed announcements, and Randy can speak more to how that's impacting the markets and our traders, we continue to see that re-engagement in July. So that, again, we're seeing a bit of that preparing, I think, for changes coming up.
Randy, Kelli just mentioned the Fed announcement that we got yesterday. What are you looking at in the market right now?
Well, that's one of the things I'm looking at, and I'm always looking at a lot of things. I spend a good part of my day doing that. But let's just talk about it in a big general sense. As much as people probably hate to hear this, 2015 really has turned out to be one of those sell in May and go away kind of years. The last peak we had on the S&P 500 was on May 21st. And just this past Monday, the S&P 500 was up less than 0.5% for the year. So with the Greek and the Chinese issues, they're both kind of on the back burner at the moment. The markets have been focusing on Q2 earnings season, which is a good thing. I think it's good when the markets are focused on domestic issues and not geopolitical concerns. There just isn't a whole lot to cheer about, as we've talked about already. And as we discussed above, there are many factors weighing on the results, and there just really isn't that much revenue growth to speak of. Now, this doesn't mean that the market's headed lower or even that we're headed for any kind of a correction, but it also means that it's probably going to be very difficult for the market to break out to new highs again without creating more concerns about valuation, which is something that people are always bringing up, that if the market keeps going higher but earnings aren't growing, valuations become a concern. Most of the sentiment indicators that I watch, and I write about these every week, sometimes every day, are in a kind of a neutral to just moderately negative sort of area. What the market needs is a consistently better string of economic data, which we haven't gotten. We've had improvements, and then we see a little bit of a pullback. It's sort of a two steps forward, one step back. Corporate revenue growth, which is critical, and a breakout in either direction will likely require some sort of catalyst. And that could be the start of the Fed's interest rate normalization process, which most of us are expecting to happen in September. We didn't get any new clues yesterday. And currently, I happen to think that that's going to be bullish for the markets. This is one of the things that clients are worried about. They think that the interest rate cycle, when it begins to rise, is going to be the end of the bull market. There's no historical precedence for that. Unfortunately, I'm afraid we may continue to be in this range-bound market for a while until we get to that point where we see that Fed hike, which is not until the middle of September.
Speaking of what people are worried about, I have a question for both of you. I mean, can you talk about what traders are most worried about? What keeps them up at night? Kelli, we'll start with you.
So I think one of the areas we've highlighted and we saw in our data really strongly is that the biggest concern that our traders reported, in fact 44% of them, is that they believe that the market is statistically overdue for a correction. And that, in a way, I mean, we've seen this kind of, the high markets that have been relatively range bound, and that sense that folks are waiting to see what happens. Yeah, as Randy said, some folks actually, about 38% of our clients believe that a raise in interest rate is a threat to the equity market. Interestingly, 45% do not. You can tell that our clients are pretty split on that, though, and I think that's actually causing people to sit on their hands a bit as they're worried about that potential for correction. They also, as we would expect, 27% said geopolitical or global macroeconomic concerns, and as well as the earnings, but not nearly as much, actually, as those who were thinking about that the market was overdue for a correction.
Randy, do you have anything to add to that?
I would agree with Kelly. I'll just go into a little more detail on some of that. So from a geopolitical perspective, there are three key issues out there, one of which is the situation in Greece. And you saw the kind of volatility that created in the market really just recently. We saw that just a matter of just a few weeks ago. Then we got to the point where it looked like they're making progress towards a resolution. There are still a lot of hurdles to reach. And then there was the major market rout that we've seen in China. That's not over by any stretch, and the reason it's not is because the market is being artificially supported by the Chinese government. As soon as the government either talks about or begins to pull back that support, the market starts to sell off again. And there's probably a significant amount of risk of a much further decline in the mainland Chinese shares if the government steps out of that. We don't know when or if that will happen, but it is a concern. Now, obviously, the market and the Chinese economy are two separate things, but I've been talking a lot about this in the last week or so, is that every dollar lost in the market is a dollar that can't be spent on, hiring another employee for your business or adding another room to your warehouse or whatever that might be. So there's an opportunity cost to every dollar that's lost. So that we still don't know how that's all going to play out or how big of an impact that's going to have on Chinese GDP overall. And then the concern about the correction. I think people do get tied up with statistics a lot of times. It's been 45 months since we've had a 10% correction. That was in the fall of 2011. Statistically, we are overdue, but I also always remind people that that's true, but you still need catalysts. You have to have a catalyst to push things to higher levels. You have to have catalysts to cause sell-offs. We had some potential catalysts. The Chinese issue, the Greece issue, those were both they've all cooled down a little bit right now. I think the catalyst people are looking for and are concerned about is this interest rate increase, but the Fed's been very good about forecasting that it's going to happen, preparing everyone for it. No one should be surprised when it does happen. We may be surprised if it happens whether in September or December, but there's, again, as I mentioned, no historical precedence that's going to cause a major meltdown in the market. It may cause a little bit of a pullback, which frankly we've seen lots of those, and they've all ended up eventually being very good entry points.
Kelly and Randy, we've only got a minute left with you, but I really want to jump to this last question. I was very intrigued to get both of your thoughts on, so this one's for both of you. Looking a little further out, what kind of impact will the 2016 presidential election have on the markets and on trader mindsets? Kelly, let's start with you again.
So we had the chance to ask our traders about this in terms of when they think the presidential race is going to have an impact on the U.S. equity market. And about a third, again, it said that they think it's going to have an impact about 3 to 6 months before the election. And I'd say even more importantly, we asked them if they think the market's going to be bullish if a Republican wins or if a Democrat wins, or if they think it's not going to impact their outlook. And 57% said they'd be more bullish if a Republican wins, and only 15% said they'd be more bullish if a Democrat wins.
Wow. It's a pretty interesting statistic. Randy, do you want to add to that as well?
Yeah, and I think it's important to sort of differentiate between what an investor thinks they would be or what they think it should be versus what the historical patterns have shown. Historically, election years seem to bring about bull markets. Now, this may be more in Kelly's area of expertise than in mine, but I happen to think that it's because human nature often makes us assume that any change will be a change for the better. In the long run, it often doesn't work out that way, but we always seem to think that it will ahead of time, and that, in my mind, brings optimism. And when you've got optimism, people invest, and when you've got investors, that pushes the markets higher. I think it's worth noting that, and this is interesting, historically, the year just before an election, which would be this year, has been the most bullish since, and this goes all the way back to like 1950, with an average return of like 17%. I have a hard time imagining we're going to get anywhere close to that this year. And it's been a positive year. 15 out of the last 16 elections, the year right before the election, which would be, again, this would be one of those years, the market has moved higher according to my calculations. So historical patterns are useful and they're fun to look at, but oftentimes nothing is ever 100% correct, and I think we're in one of those modes. So historically, next year should be a bullish year because it oftentimes is, and the average return somewhere around 7% or so, but this should be a really bullish year, and frankly, it's not. So there are just so many other factors that come into play, but those are always fun to sort of take a look at.
We've been on the line with Randy Frederick. He's the Managing Director of Trading and Derivatives for Charles Schwab Center for Fiscal Research, as well as Kelli Keough. She's the Senior Vice President for Schwab Trading Services. It's been a great source of sentiment, data, trading strategies, historical price action. I mean, I can't thank you both enough for joining us on the show this morning. We'll definitely have to have you on again soon.
Our pleasure. Thanks for having us.
Thank you, Brianna. It was nice talking to you.